the ultimate destination for smart investing. Welcome to Invest Ideas, where we turn your financial dreams into reality. Subscribe now and join us on the path to financial freedom. Hey there! Let's talk about self-made billionaires, investments, and how to turn your $1,000 into more money. So, who is the fastest self-made billionaire ever? It's none other than Jay Walker. While Warren Buffett took 55 years to join the Billionaires Club, Jay Walker did it in less than a year by launching Priceline.com during the dot-com bubble. However, that wasn't sustainable, and his net worth crashed when the bubble burst. Buffett, on the other hand, is still on top of the list and doesn't seem to be going anywhere anytime soon. And that's the kind of wealth you want to build, steady and long-lasting. Investing in the game of money isn't easy. It's taut, competitive, and ruthless. If you don't know the rules, you are doomed to fail. Many people work hard their entire lives but end up poor at the end of the journey because they don't know how to let their money make even more money. In other words, they don't know how to invest. Let's assume you have an extra $1,000 in your bank account. That's an achievement because nearly 70% of Americans don't even have an extra $1,000 in their bank account. So, instead of spending it on another useless gadget or a pair of shoes that you'll wear once and then keep in your wardrobe for many years before you finally throw them away, let's assume you're going to invest that money. But how do you invest your first $1,000? Do you invest it in real estate or the stock market? What kind of stocks do you buy? Is $1,000 enough to start investing? Don't worry. We're going to answer all of these questions and more. So, give this article a thumbs up and let's get started. To understand what investing is and how it works, let's consider this example. Suppose you've worked so hard and saved $300,000. You can visit a Ferrari store and get yourself a luxury car and let everyone know how successful you are. Or you can buy real estate, a house, and rent it out. Every month, you'll receive at least $2,000. If you decide you no longer want to keep receiving that $2,000 paycheck every month, you can sell the property and get back your initial investment. In fact, the value of your investment might even appreciate, so you'll sell it for a higher price. And that's how money makes money. But you can't buy real estate for $1,000. That's not even enough for a down payment. However, that doesn't mean you can't invest that $1,000 elsewhere and let it grow. The easiest way is to deposit it into a savings account and generate interest. But why would the bank pay you for keeping your money in the bank? Shouldn't they charge you instead? Well, the bank is going to take your money and loan it to someone else at a higher rate and would share with you a portion of that profit. That's how banks work in short. The only problem with this strategy is that interest on the deposit account is so low that it isn't worth it. The highest rate you can probably get is 0.8%. That means if you invest that $1,000 into a savings account, 12 months from now, you'll receive an extra $8. That's extremely low because the Fed targets an inflation rate of 2 to 3%. If you're not getting at least 2 or 3%, the real value of your $1,000 will depreciate over time, which means you can buy fewer goods every year. But why are interest rates so low? It's because of the current economic conditions and policies set by the Federal Reserve. When the economy is weak, the Fed tends to lower interest rates to encourage people and businesses to borrow and invest. When interest rates are low, it becomes cheaper to borrow money, and people tend to spend more, which stimulates the economy. On the other hand, when the economy is doing well, the Fed raises interest rates to slow down inflation and prevent the economy from overheating. So, if investing in a savings account isn't the best option for your $1,000, what else can you do? One option is to invest in the stock market. With the advent of online brokers, it's easier than ever to buy stocks and build a portfolio. However, investing in the stock market can be risky, and you need to be prepared to lose money. A good rule of thumb is to diversify your portfolio, which means investing in different companies and sectors to spread your risk. You can also invest in mutual funds or exchange-traded funds, ETFs, that offer exposure to a broad range of stocks. Another option is to invest in individual stocks, but you need to do your research and analyze the company's financials and prospects before investing. Remember, investing is a long-term game, and you shouldn't be swayed by short-term market movements or news. If you're patient and have a diversified portfolio, you're more likely to generate a decent return on your investment over time. In conclusion, investing your $1,000 isn't easy, but it's worth it if you're willing to put in the time and effort. You can start by educating yourself on investing and considering different options, such as real estate or the stock market. Remember to diversify your portfolio and be patient, and you'll be on your way to building long-lasting wealth. Thanks for tuning in to Invest Ideas, where we bring you the latest insights and strategies to help you make informed investment decisions. Don't forget to hit the subscribe button and stay ahead of the game. Until next time, happy investing.